Howdy there, folks. Welcome into this 5-piece here today. 5 different videos for me to react to. Holy smokes, this is no dang joke, folks, okay? First one up here. Jump into this rally and let it run until the first rate cut. Going to hear what SoFi's Liz Young and a few others have to say about this current rally, how long they think it's going to last. Then we're going to jump into this one. Investors are itching to get out of cash, says Gabriela Santos. So looking forward to getting into that one. Then we're going to react to this one. What if $6 trillion in cash on the sidelines comes into the market? I think it's an important subject to discuss that from several different angles. The bullish angle, the not so bullish angle, and all those sorts of things, okay? Then we're going to react to this one. This is JB Josh Brown. We have vanquished 9% of inflation. The 2023 bear case is dead. But what about the 2024 bear case, okay? So we'll speak about that and react to that one in this video. And then the last one up here, Tom Lee, Fun Strat. This little 4-minute clip, small caps could climb 50% in the next 12 months. Appreciate everybody joining me as always. Thanks so much for being here for this beast here today, folks. Thank you for being subscribed to the channel. We're now over 37,000 subscribers here on the reaction channel. So I appreciate each and every one of you. And I also recorded you guys a free workshop in the last 24 hours or so, how I'll invest millions in 2024. It's about a 45-minute workshop, goes all into how I'm going to be investing. Am I going to be buying stocks? What type of stocks am I going to be buying? What about real estate? What about cash levels? All those sorts of things. Very in-depth video. So if you'd like access to that, that'll be the pinned comment down there. It's absolutely free to access that and enjoy that, okay? All right, guys, let's jump into this.
It's Liz Young to you first. To the Bears. Throw caution to the throw caution. I didn't say you. Throw caution to the wind now or what?
She has kind of been a bear.
First of all, I'm excited to be in the market zone. I never get to do this.
All right, well, welcome.
I think you can throw caution to the wind for a little while. Things changed today, and Gunlock used the word pivot. We moved to a different part of the conversation, right? We went from, they were talking about maybe hiking. Now they've basically declared that's over. We're talking about considering when we should be able to cut. Now, the idea of the market pulling cuts forward, though, I think is precarious, right? We continue to pull them forward.
By the way, let me just say this real quick. You know, a lot of people have been picking on my hair, picking on my beard recently. Like, listen. It's Christmas, so I'm trying to grow my beard out. After New Year's, I'm going to shave, okay? I'll shave. People have been picking on my hair. I don't think it looks that bad. Maybe I just have really poor judgment in hair. But, man, I've been just getting trashed lately about my beard, about my hair. Man, oh, man, it's been tough out here to be a YouTuber. Oh, man.
We don't have a lot of time between now and March, and the Fed likes to foreshadow things really far in the future. First we talk about cutting, then we actually cut, right? So they need a little more time than that. I think pulling it forward is dangerous. The other thing that I know I've mentioned on this program is that the period between the last hike and the first cut is usually okay. So I think you can, for the time being, jump into 100%. This rally, let it run, let the clock run on it. But as soon as that first cut comes...
Yeah, in that, exactly. And that's why I say, why are people in such a hurry to get rate cuts? I'm not in a hurry at all. I say, let's have no rate cuts at all in 2024. That would mean the economy held up really good. Earnings were really strong. The stock market was really strong. Like, that would be, like, best case scenario is the Fed does not cut rates in 2024. That's best case scenario. Because that would likely mean things were just super, super strong. If the Fed does start cutting, then you got to start worrying, like, why are they cutting? It's usually not because inflation's going down. It's usually because they see problems coming in the economy down the road. And so then that starts to get into a little bit of a scary time period where it feels like a tick, tick, tick situation in terms of, okay, how long till it goes bad? I'm in no rush for rate cuts, man. No rush at all.
You get more nervous.
Mike, save for...
When rate cuts start, I'm not going to get more confident. I'll get less confident.
Happening today, this was about as dovish as the Bulls could have ever hoped for, right?
I think it was high hopes exceeded, because I think we really did expect more or less a nuanced type of pivot, and it was much more explicit. You didn't have to read between the lines. He didn't throw out as many of the typical disclaimers of saying, don't really look at the dots. They don't mean anything.
As I said,
that's what he sometimes does.
He didn't hawk it up.
That's right.
To walk back anything from the statement.
Right. Now, that being said, and of course, you mentioned the Dow. The S&P is within 3% of its record high. It's pretty rare you get within 3% of the record high. You don't at least make a run at it over the next couple of months and maybe hit it. So all the things moving in the right direction. A lot of technical repair in this market. The Fed is now no longer pushing against it. We got confirmation, too, of a couple of things I'm trying to look at, which is the Fed is not really targeting market levels. It's not looking for bank shots of trying to influence financial conditions this way to get inflation to do what it wants. It cares about inflation. It's the only thing that matters. So therefore, the atmospherics around it, they don't have to look at job openings anymore. It's all about the inflation numbers. That being said, so much has worked in favor of this market in the last 2.5 months that you have to start to sit back and say how much is left. You had the soft landing celebration rally. You had the rate relief rally in banks. You had kind of the low quality, heavily shorted garbage that got washed out. And you had a repositioning rally because people didn't own enough stocks. A lot of that's different right now. So I think you have to be at least cognizant of the idea that it's everybody can clap and say we did it, and it's a culmination type moment, and then figure out what it takes.
Okay, what he's saying there is very fair. In my belief on the indexes, right, versus like individual stocks, I believe we have pulled a lot of gains forward in regards to the indexes, right? Doesn't mean we've pulled all the gains forward, but we've definitely pulled a good chunk of those gains forward this year, right? Going into 2024. I think there's still a lot of stocks that have a long runway ahead of themselves in 2024 and beyond, regardless of if the indexes do if they do good, anything like that. So, I think there's a little bit of difference there. And if we can get the indexes just kind of be in a little bit of a flattish place or slightly up, I mean, you'll still see some stocks climbing 50% to 100% next year, even in that sort of environment.
And maybe a 4% nominal GDP economy next year, if we're lucky and everything comes through, it's a different tone than what we've been dealing with recently.
I mean, Josh, he had a chance today to express any sort of concern or worry that financial conditions have loosened, given, the 10-year's down 100 basis points in 6 weeks, and stocks are up an awful lot in 6 weeks. And he really didn't do that either, to Mike's point, that they are, if this doesn't tell you that inflation is the only game in town, then nothing ever will.
Well, he also has to be intellectually consistent. So if we're saying during the tightening cycle that it operates on a lag, then let's also say that cutting rate, the risk of cutting rates is probably not an immediate risk of things getting too loose, because that operates on a lag as well. At least that's how I would choose to see it. I'm curious from you guys, the 2-year, we talk a lot about the 10-year, the 2-year down 30 basis points today, 4.45. Is it down enough?
Well, a one-day move in the 2-year, first of all, you look at that chart and take the title off of it, you'd think that was some kind of small cap.
Looks like Snapchat after reported earnings.
Right. So first of all, just volatility that big in the Treasury market is not a comforting sign to me. Is it down enough in one day? I think that's plenty in one day. I think over the course of the first quarter of 2024, it's going to come down considerably more, especially if we expect rates to be cut starting in March. But then what that means is the yield curve uninverts, right?
Yeah.
Then you've got a re-steepened yield curve, which might be good for things like financials. And again, you've talked about the valuations, I think, earlier in the show. That might be a good time to start towing into something like financials. But an uninverting yield curve at the beginning of cuts is usually a dangerous time for markets.
Mike, the top two performing sectors, utilities number 2, XLRE, S&P real estate number 1. Not a shock to me. Is anything about that surprising?
No, pure
textbook, right?
Yes.
Yeah, so why are some of the big dividend payers starting to climb here? Why are utilities stocks starting to climb here, right? I'll tell you exactly why those stocks are starting to run. So the thought process is the Fed is not hiking anymore and their next move is cutting, right? And then several cuts coming. That's what Wall Street's kind of expecting, right? Well, think about it. If that happens, that means likely treasuries are going lower, which means likely people are searching for yield and to start to position into yield. Now, what have I been telling you guys for, this entire year? I said, watch dividend stocks at the end of this year going into 2024. People will start to position into them because they're going to start to want to position into yield. So you get the early stage people in at first, and then after that, you'll get the late stage people, which will be kind of a little bit more second half 2024 in regards to dividend stocks. No different than if you look at this year, the early stage people actually started positioning into tech at the very end of 2022, right? That's when all those stocks pretty much bottomed around October 2022, mid-October. The early stage started to position in and then kept positioning in. And then we kind of had a flat line in the summertime a little bit. And then we had the late stage group come into growth stocks at the back half of the year, right? Same thing I foresee kind of happening in dividend stocks, utilities, those sorts of companies. And that's why those are already starting to climb. You got early stage people already starting to move money there, right? And that will continue likely for several months, and then we'll have a flatline period for those stocks, maybe even a down period, and then the next group will come in, and that will be kind of more of the late stage people.
Market and Fed are aligned or at odds, and how that could influence the rally in the weeks ahead. Let's ask Gabriela Santos, Chief Strategist for JP Morgan Asset Management, with me once again, Post 9. Welcome back. It's good to see you.
Good to see you.
How are you thinking about what might happen this week?
So it is the last big week of the year, and really investors are going to be looking for that confirmation of growth without inflation and peak rates, looking to the other side of rate cuts and exactly what precipitates them. We think it'll take, at this point, a big surprise on the downside or the upside to get much movement when it comes to the stock market. And that actually, if you look at bond yields, we're...
Interesting. We need a big move to the upside or downside to get a big move in the stock market. Okay. I don't think I disagree with that necessarily.
A little bit vulnerable because of a little bit of dichotomy between what investors are expecting for the first rate cut and what the Fed is likely to do.
Okay, let's go there then, because that's sort of how we set up this conversation, whether, the market and the Fed are aligned or whether they're at odds or offsides with one another. You think they're a little offsides?
A little bit. I think in general, the direction is clear. We've seen the last rate hike. The next move is going to be a rate cut. But I think that if you look at probabilities, there's still a 40% chance of a rate cut in March. I think unless you have a big actual economic slowdown, we're unlikely to see that, even though we actually think inflation will come down faster than the Fed is expecting. So it's really just talking about pushing it back a few months, expecting the first rate cut to happen in June or July. So it's nothing dramatic.
You're expecting cuts, though, in 24.
We do expect cuts. So it's nothing dramatically offsides. It's just in the very short term, you could see a pop in yields as those rate cut expectations are adjusted a little bit more in line with
that's
the
a
Fed.
potential.
Are they cuts because they can or cuts because they have to?
So
that's a potential. And because I've been thinking about, I think there's going to be, if you guys know my opinion, what's going to happen in the first quarter of 2024 at some point in time. If you know my opinion on that, you know it, right? It is that at some point in the first quarter of 2024, there will be some sort of big short-term sell-off. I don't know if it comes in more January, more February, or it could be March, but I think at some point we're going to get some sort of big short-term sell-off. And I think, it's going to be kind of like one of those periods where it was like, oh man, and everybody kind of freaks out a little bit because we kind of just been a lot of bullish euphoria, and all of a sudden a lot of bear cases going to come back into the market for, it might even be a few weeks, it might be a month, something like that. It might be a couple months where it's just kind of like the bear case really gets talked about a lot. Oh, what could go wrong? And maybe it's a spike higher in yields. And maybe that, money floods back out of stocks and into yields or something in the short term. But there's going to be some reason for it, though. They'll blame it on something. So maybe it is that, what she's talking about here with the pop in yields, maybe that's what will happen. And maybe that's where everybody will talk about and blame it on at that particular time. But all it comes down to is really a lot of these Wall Streeters are going to be looking to take profits in the first quarter because they've made a lot of money. A lot of these tech stocks have been positioning into them, and I know they're going to want to take profits, and they just waiting till after this calendar year is over. And so that's what it's really about, though. It won't. The truth is they're going to blame it on Treasury yields, or they'll blame it on whatever. But the truth is they just really want to take some profits. Okay, there's always like what they're talking about, and then what's the actual truth? There's two different things.
In this case, we continue seeing growth without inflation, which is what the jobs data confirmed last week, and we hope to see also in the CPI retail sales this week. So in that environment, rate cuts by mid-year really are because they can, because inflation is coming down faster than they expect, and that opens the door to start actually lowering nominal rates so that real rates don't increase much more from here.
Do I make the leap and then say you must be bullish stocks for 2024?
I think the number one conclusion for us is a lot of investors are frustrated with the markets this year because they sat on too much cash. And despite all the ups 100%. And downs, the 60-40 still gave you 3x cash this year. It'll get even worse next year, given that we think the peak benefit of cash is behind us. So that's the number one thing to do. Use the pop in yields when they happen to extend duration a little bit. Use pullbacks in the market to actually lean in to some of the laggards where it makes sense. You don't want to go two on the other.
Now you're getting into a weird, awkward situation with the stock market. very similar to the real estate market, right? If you know the real estate market, you know a lot of people are always like, wait until real estate prices drop. Wait until the real estate crash. And I've heard people talking about this for 10 years now, right? They're going to be talking about it in the future. And every time we get a little drop in pricing, people don't really take advantage of that. And they're like, I'm waiting for the big drop, 30%, 50%, 40%, whatever. And so we're getting into an awkward time period where you could actually have this start to happen more in the stock market, where people kind of are holding out to buy because they're waiting for that big drop to happen, right? And then the higher it goes, the more frustrated people get because they're sitting in cash and they're renting versus owning, right? And so, that's a potential, man. That's a serious potential for this market that we could be getting into that sort of market. And I could understand if let's say I wasn't buying the dip in 2022 and I wasn't buying the dip this year and I was just all treasuries, I'd be pretty frustrated because the amount of stocks this year that have climbed between 50% and 400% is a long list. It's a long list of stocks. And then you're thinking, wow, I'm doing so good collecting my 5%, and you just missed out on a 50% gain in this stock. And the thing is, with these gains, they're in the easiest stocks. It's not like it's like, oh man, no one ever heard of that company before. Like Microsoft, look at Microsoft this year. Like Nvidia, Meta, like these are the easiest stocks to buy. Tesla, you go through the list, AMD, like all the easiest stocks have all gone up like 50% plus this year, if not 100% plus. And then you're over there collecting 5% treasuries and you're looking and you're like, seriously, I could have just bought the greatest companies in the world and made 50 to 100% of my money, and I instead made 5% because I thought I was doing the prudent action. That can cause a lot of frustration in a lot of people. I can understand
extreme
that.
Of risk.
Okay, so you're talking about a rotation from cash into the lagging sectors of the market, the ones that really didn't wake up until the beginning of November.
Yes, and I think it's a very fast-changing market. We went very quickly late October to how high can rates go when it's a very concentrated, narrow leadership, all of a sudden to how low can rates go, and an everything rally. So you don't want to be participating on either of those extremes. You do want to diversify exposure, but you don't want to lean into, for example, for us, not quite the time yet for small caps or financials or retail.
Why not small caps? 'Cause,
Not the time yet for small caps? What is she going to have to say in regards to this? This is an interesting statement. Oh boy. Here we go.
Russell's up almost 11% in a month. Yeah. So if you think there's going to be a broadening out and the economy's going to hang in there, the Fed cuts because they can, not because they have to, why wouldn't I want small caps?
So I think we do still want some allocation to small caps, and you still have valuation discounts, historically large versus large caps, so building some exposure. But if it's about overweights, that marginal dollar, we would still prefer quality large caps. And that's because a soft landing still doesn't mean things are great. And I think the discussion for next year is going to be a lot more, where are we in the cycle? Where do you see pressures late cycle? And that tends to be small cap. Small caps also have a lot more floating rate debt, so they are already feeling the pinch of higher rates, and the Fed is unlikely to cut it fast enough to ease that pain in the immediate future.
But it's fair to say you're a believer.
They cut it off. No, she talks about late stage cycle, and this is where all Wall Streeters are almost all Wall Streeters are convinced we're late stage cycle, right? We're getting ready for the big recession whenever it comes, right? And something has to be factored is maybe we're not late stage cycle right now. Maybe we're early stage cycle, right? Maybe 2022 was the actual recession that they didn't call a recession, right? And, really tough time for stock market earnings. Even the greatest companies in the world had trouble growing their earnings. Usually a telltale sign that you're in a pretty dark recession, right? Home sales numbers down to the lowest we've pretty much ever seen in the United States of America, right? I mean, incredible, worse than the great financial crisis in terms of amount of home sales. That's pretty recessionary. You have automakers, a lot of them, not doing the best recently. So you look at a lot of those things. You look at a lot of the jumps in look at consumer confidence in 2022 and 2023, horrible. Look at small business confidence index, 2022 and 2023, horrible. Those are all recessionary signals. Those are all things that make you say, you had a big recession. You had a massive recession. You just didn't feel it as much because unemployment was low. But if you look at every single other thing, look at real wages and tell me we didn't actually go through a big recession already. Look at the stock market. NASDAQ went down 37, 38% peak to trough from where it was in 21 and 22. You're going to tell me we didn't have a recession? The third biggest drop in the S&P 500 in the past 40 plus years, we didn't have a big recession? Maybe we did. Maybe, just maybe we did. And we're actually early stage cycle. And we're actually several years away from the next big recession. Something that has to be considered. It's not a for sure, but it's just something that should be considered. Everybody wants to assume we're late stage cycle. It's like, you should at least consider the possibility that we're early stage cycle right now. Maybe we're in the second or third inning. Something that just should be considered. What happens if $6 trillion in cash on the sidelines comes into the market?
$6 trillion in money market funds as high interest rates gave those.
So first off, before we even go further into this video, let me say this, okay? So $6 trillion roughly in money market assets. Listen. It is a fool's game to say $6 trillion is going to come out of money market funds and into the stock market. That's not happening. The number that is a potential is $1 trillion. There is a potential $1 trillion could come out of money market funds over into the stock market. If you look at kind of how much we raised up that number in 22 and 23, that's really the most recent money. $5 trillion probably-ish is going to stay over there in money market funds. That's not coming out of those. In my opinion, the best case scenario is maybe $1 trillion, maybe 1.5 trillion comes out in over the stock market. But yeah, to say all the money's coming out of money market assets and in the stock market is that's silly. That's silly.
Returns in the stock market. But if borrowing costs fall in 2024, will that hoard of cash make its way back into equities and push the markets higher? Our next guest says history could be telling otherwise. Let's bring in Adam Turnquist, Chief Technical Strategist at LPL Financial. Adam, great to have you with us. You actually wrote about this in August. I thought this was really interesting, the chart, because you find that it's not now. People aren't going to be cycling back into equities right now.
That's the message history has told us. When you look at the previous 4 major peaks in money market assets, they really did not start to roll over until we were well into the rate cutting cycle. I'm still getting used to saying rate cuts after the last year here, but that's really been the trend in history. And I don't see any slowdown. If you look just at November fund flows into money market assets, you had $200 billion going into money market assets despite rates coming down. So that trend is still up for now. I do think that you'll have some flows coming into equity markets, of course, and support the market, especially a lot of offsides positioning. There's confidence in this market as well. And I think we've seen the highs for interest rates. So supportive for the market, but I don't think it's worth holding your breath for an imminent trend change here with fund flows into money markets.
But Adam, and I agree with you. I see it with my clients. I think you also, though, have a dynamic. How do folks feeling about do they feel like they've missed a move in the markets? And if you think about the intensity of where and how quick the velocity of the move higher.
If they don't feel like they've missed a move in the market, then they're not of reality, because I have missed a move in the market. You've been over there playing around instead of in the market. You missed a epic move.
A lot of people off the sidelines. And as Courtney referenced too, it's great to earn 3 to 5% in the front end of the Treasury curve, but at some point.
By the way, that's how perma bears are born. If you never knew how a perma bear is born, basically, here's how it actually happens. You have some sort of event, market tanks, people, that person, they sell their stocks. Then they're over on the sideline and they say, I'm going to get back in at some point. Then the market goes a lot higher. They don't think it should go higher because the data is not there right now. It doesn't deserve to go higher. This is still bad. This is still bad. This is still bad. Then market goes higher again. Things are starting to look a little better. And then the perma bear says, valuation is too high. This is too high. This is too high. This is ridiculous. It shouldn't be this way. Then what happens? Market goes even higher. The bear case erodes a little bit more. And then they say, this is ridiculous. I've missed out on all these gains. And this is how, and then they start looking at everything from a negative angle. And the reason they start looking at everything from a negative angle is because psychologically, they're wanting the market to go lower. So they can only start seeing the negatives. They can't even see the positives anymore at that point in time. And that's how a true perma bear is born and let's call it grows up. And next thing you know, it's only the negatives, only the negatives. They can't even see the positive because their money is dictating how they think. And they wish the market would come down to some arbitrary number so they could actually buy in. That's the truth. It's no different than the guy that hates on that girl all the time, but he really wants to get with that girl. That's a perma bear, folks. I just explained it to you. Keep that in mind.
Outperform over time. And so when you see this kind of a move in markets, it's hard to feel great here if, in fact, you've been cashed up.
Yeah, and the other opportunity cost is not locking in some of these yields right now that you're seeing in the market. So if you're missing on both ends, if you're missing that equity market rally and some of this rally that we've seen in treasuries, we think, and we've been telling our investors and clients to really lock in some rates. You don't need to go far out on the curve. You don't need to take additional credit risk into high yield. Lock some of these rates in now. We think, again, that the upside in yields is likely capped as we look ahead to 2020.
What did I tell you guys? I told you wherever it looks like easy money's at a particular time, it's always a trap. Always remember this for the rest of your life. Wherever it looks like easy money's at, always a trap. Like 100% of the time, okay? And I've been looking, obviously we've been hearing about this treasury talk and it looks so easy. Oh, come put your money in treasuries, get 5%. You can never get 5%. It looks so easy, right? And everybody's been talking about that for the past year and a half. It's a trap. It's been 100% a trap. They trapped you over here in 5%, and you're missing 50%, 100%, 150%, 200% gains in the easiest stocks in the world to invest in. It was a trap the whole time. People just didn't realize it. Go back to the stock market, end of 2020, beginning of 2021. Easy money. Everybody wants in the stock market. It's easy money. It was a trap. Then it was crypto. Oh, crypto, look at how much Bitcoin's going up. Look at all these altcoins. Come over here. Look at it's easy money. Look at these yields you can get. It was a trap. Then it was NFTs. Trap. Every time. It looks like the thing I'm next worried about is I'm worried actually about the next bull cycle in real estate being a blow off the top scenario. And then everybody starts talking about real estate. You can't lose. It only goes up. Look at it. It's been through all this and look at this. And then that will be the next trap, which would go back to the great financial crisis, right? And so maybe that trap hits in a few years from now. Maybe it doesn't hit right now, but maybe we have some sort of blow off top scenario in real estate over the next couple of years. Maybe everybody starts moving again, getting excited about real estate. And all of a sudden, 2026 or 2027 or something like that, you have some sort of big epic crash in real estate or something like that. Always, man. It's always where everybody's talking about this is easy money. It's always a trap, man. It's always a trap. It's so funny. And like I said, everybody and their grandma's been talking about treasuries. Easy money.
Is
Trap.
there data, Adam, on
Always
where
is.
that money actually goes when it goes from a money market or treasury bonds? I'm sure not a lot of it goes straight into equities. Some of it must go elsewhere, like maybe corporate, some sort of intermediate step.
I think if you think about fund flows, fixed income is probably going to be first downstream coming out of money markets. If you think about the investors that are sitting in money markets, I think from a comfortable standpoint, I think, again, they're probably going to move into more of a fixed income, safer security versus chasing this equity market rally. In terms of data, we did see some pretty good evidence of fund flows coming back into U.S. equities just over the last week, of course, powering this rally that we've seen broaden out significantly over the last several weeks.
All right, Adam, we're going to leave it there. Thanks so much for joining us. Appreciate it.
Thanks.
Very nice. Next up here, we have vanquished 9% of inflation. The 2023 bear case is dead, says Josh Brown. This should be interesting.
I'm crying. I have tears in my eyes.
What is your assessment here now? What does this mean for stocks moving forward? Let's just take it from there.
Some stocks are overvalued, but on the whole, the asset class, not overvalued. That's the only thing Jeff just spoke for 30 minutes. The only thing I disagree with him, the blanket statement that stocks are overvalued. You can buy small caps for 12 times forward earnings. You can buy mid caps for 13 or 14 times forward earnings. You can buy large cap basic materials 9 times earnings. I feel like there's a lot you could be doing away from the S&P 50. Most of which are tech, consumer discretionary. There's a lot you could be doing where you are not overpaying for stocks, especially if you want to take the Fed at their word that we're going into a cutting cycle. I categorically disagree. Money markets were the trade of the year. $6 trillion in money markets right now. We don't need it all, quote unquote, all to go into stocks.
It's the L of the year, not the trade of the year. It's the L of the year.
Meaningful portion of that $6 trillion goes into stocks. Doesn't have to go into the SPY ETF. It can go into dividend aristocrats. Look at them. NOBL. Look at the way they're treating the VIG, Vanguard dividend. This is where the money is flowing right now because everybody understands this. You could buy stocks without buying the 7 stocks, and that's the trade right now. I think that trade carries us through. I have tears in my eyes. This is like the end of a romantic comedy. Everything fell into place. We're going out. We're going out with a VIX at 12. What else do you want? We have vanquished. Who's laughing? Liz? I will see you in a minute. We have vanquished 9% inflation. We did it. We did it without a single person losing a job.
Liz Bear.
Please understand that. We just printed plus 199,000 new jobs last month, and the war on inflation has been won. VIX at 12, stocks cheap enough to buy. All of the most widely held stocks in America having massive double digits, in some case triple digit rallies off the lows. Plus, we averted a potential banking crisis. What else could you have asked for out of 2023? I don't know.
You make the argument that the bear case is firmly dead.
No.
At this point.
No. The 2023 bear case is dead. The 2024 bear case is still ahead of us. There are probably going to be reasons to be concerned, but right now, as we end the year, you think about all of the things that went bump in the night, all of the things that we focused on day after day that could go wrong. None of them went wrong. They still could. They haven't. That's the story of by the way, the story of 2023, a lot of conventional wisdom got turned on its ear once again. One of the big ones, I was talking with a housing market expert yesterday. You had Fed funds, essentially, you had mortgage rate go from 6% in February to over 8%. It actually started from 2.6% 2 years ago. What did home builders do this year?
All-time highs.
Up 50% on the year. That's not supposed to happen. A lot of things that weren't supposed to happen. And the big story, the Fed...
Economics makes a fool out of us all the time. That's why, at the end of the day, it's usually not worth even trying to make... You never make investment decisions based upon macroeconomic opinion of yours, because your opinion's likely wrong. Doesn't matter how smart you are. Doesn't matter how long you studied. All these people, that's all they pay attention to their whole lives. They went to college and they got master's degrees in economics and they still can't forecast crap. They went to school for 100 years. They focus on this as their whole career and they still can't forecast crap when it comes to macroeconomic landscape. Nothing. And they're wrong again and again and again. Experts are wrong again. That's why don't ever make your investment decisions based upon how you feel the economy is at the moment, or it's going to be. It's just not the right thing to do, man. It always, 100% of the time, is the wrong thing to do. Always.
Not supposed to be able to, quote unquote, win the war on inflation without costing us any jobs and without throwing us into recession.
Because as the Fed chair, and I thought this was interesting too, and we didn't get to talk about it yet in the news conference, he was discussing why in his mind the inflation that was caused in this cycle wasn't traditional. It wasn't caused by some out of control demand. It was caused in many respects by supply shocks. Sure, you can criticize the fact that they waited too long. They were buying mortgage bonds when mortgage rates were low. And you can criticize the government for piling on with a lot of the stimulus, but in many respects, maybe the reason why we're even having this conversation is because those things happened. And the reason why he can maybe declare victory at one of these next meetings is because better late than never. They were aggressive, they were quick, and now we're going to see what happens.
So Jeff was quoting from Braveheart. I'll do my own. William Wallace said, we all end up dead. It's just a question of how and why. Every bout with inflation ends up dead. It's just a question of how and why. The 1970s inflation paradigm was the wrong paradigm. I'm not the only person, obviously, that pointed this out, but I still think it's really an important lesson. The real paradigm to have focused on was post-World War II. We had tons of stimulus in the system. That's what was necessary for the arming of the country and the world against the Axis. That inflation took like 10 years to work itself out of the system. We had rising rates throughout the 1950s, and yet stocks were able to work, and we didn't really have any meaningful economic issue. That was the right paradigm. We had this massive burst of stimulus to make sure that society didn't tear itself apart, and we told people to stay home. It worked. We actually did too much of it, but it was not this lingering issue in the way that it was when we had oil embargoes and the like. It was man-made. We created it, and we were able to allow enough time to go by for that inflation to moderate. And it's not fully out of the system, and people are still paying high prices for shelter, for healthcare. Auto insurance sucks. I get it. I'm not saying like everything's great. Considering how much worse things could have been in this fight to bring inflation down from nominal 9% back on the road to 2%, it could have been way worse, and it was.
Fair play, fair play. All right, next one up here. Small caps could climb 50% in the next 12 months.
Here we are again. The S&P's at 4719, and your year-end target is what?
4750 to 4800.
That's crazy, Tom. That's crazy. How do we get there from here?
Yes, I know. Anything can happen the next 2 weeks, right? Yeah, I think it's been a year where markets have been surprised by not only the resilience of the stock market, but the fact that inflation fell really quickly, and the Fed, which had really held really strongly to a data-dependent view, an inflation war view, I think essentially gave that up yesterday. I mean, I think it's now proven the Fed is now focused more on managing the business cycle.
Okay, so what can you still put your money into from here that has upside? I mean, the commercial real estate arena perhaps is easing off with the long bonds not so problematic. So we saw the KRE, the regional banks.
Commercial real estate, come on, man. Come on. No. I mean, there's so many more interesting opportunities in commercial real estate. Like, oh, gosh. It's not that you can't make money there. It's just like, is that really your best option? I mean, if you had to tell me personally, commercial real estate, I would rather just be in cash. Or, excuse me, not cash, but like savings or treasuries yielding 4 or 5%. Personally, I'd rather just be in, if I got to pick commercial real estate or that, like, dude, I'd rather just collect the 4 or 5%. I don't freaking want to be in commercial real estate. Of all the opportunities you got in the market, that's the best you can come up with. Commercial real estate,
a bit better. What areas do you see that have potential?
Well, I think investors in the next 12 months are going to start to say, what things get fixed if the Fed just stops being so aggressive on rates, right? So if rates fall, and it makes a lot of sense that asset quality gets better if rates fall for the banks. Commercial real estate comes back. Small caps, which are highly levered or higher levered, really benefit. So to me, this, the next 12 months, it seems like small caps can be up 50%. The Russell 2000 just crossed 2,000 today. So
50%.
Yeah, so it could be Russell 2000 hitting 3,000.
I mean, we're seeing it today, to your point. It's another 3%, almost 3% day for the Russell 2000. It's up 8% in a week. It's up 17.5%.
Dude, I'll take 25% in the next 12 months. I'll be the happiest little piggy. 25%. 50% in the next 12 months? I'll be happy with 15%. 15% small caps in the next 12 months. I'll be a happy camper. Dude, 50%. Oh my gosh.
In a month. How much of this hinges, though, on yields continuing to move lower? And is there a point at which this steep fall in yields actually signals issues for stocks rather than positivities?
Yeah, I guess on that latter part, you're wondering if it turns into a growth scare. Mm-hmm. I think that people are trying to figure out what message is coming from lower rates. But remember, it was just in October where everyone said term premia is permanently higher. Future inflation expectations are higher. The Fed has to keep a higher neutral rate. I think on 3 of those things now, given how much inflation's fallen, I don't think there should be the term premium. It should return to normal. The neutral rate probably is staying lower. And then inflation expectations are coming down. That means the 10-year, could be below 4% for all of next year. And that would be really big for small caps because, on a price-to-book basis, they're trading at where they were in 99 relative to the S&P. And that was the start of a 12-year outperformance cycle.
What if inflation doesn't continue to fall?
The thing I love about Tom Lee just pulls out all these random old stats and facts out of out of his brain. Let's just call it that. Like, it's just so random. Like, oh, back in 1999, through a 12-year outperformance cycle, and it's just
as
cracks
fast
me up,
and furious as it has. What if it gets really sticky here?
Well, I think that's the misconceptions. 60% of core CPI is housing and car plus car services. Housing and car services account for 1.74 percentage points of the excess inflation.
See, 1.74%. It's beautiful. It's just hilarious.
We're at 1.6% of the excess. So literally those two things account for all of the inflation. Housing just needs to stabilize at 3%, and used cars are going to fall like 30%. So, I mean, I think inflation is going to easily hit the 2% core target sometime next year and sort of stay there.
Why shouldn't we worry about
if you guys don't know, all the Tesla owners are mad right now. Why are they mad? Tesla owners are upset. And the reason being is they're all realizing, crap, if I need to sell my Tesla, I'm probably underwater on it. If you bought it in 2020 or, well, really like 2021, 2022, which is actually when Tesla sold, the most cars they ever had in the United States, right? And obviously 23 is a good year as well. But a lot of current Tesla owners that bought in the past few years are very frustrated because they're realizing, crap, if I want to go sell my vehicle, I'm underwater on that vehicle. And that's not a comfortable feeling. And so there's a lot of, if you're really in the Tesla communities, a lot of customers, and these aren't stockholders, a lot of customers are upset with Tesla because Elon obviously lowered the price so much over the past 12 to 18 months now.
I mean, it's an election year coming up in 2024. One of the potentially big spoilers of 23 was Congress not being able to function. Does that pose any danger for the markets?
It is a perception question because, gridlock historically is good for equities. In 24, I think people expect Senate to flip and House to flip, so it still remains gridlock. I don't think Washington dysfunction it can be sort of create seismic events, but in 2024, those will probably prove to be buy the opportunities. Interesting. Yeah, we'll see. I'm a little concerned about the election stuff as well. I do think that will add an element of volatility in the market. I'm pretty confident that will add. That's more of like a end of third quarter, beginning of fourth quarter type story in regards to that, though. Okay, appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. Make sure you get my new free workshop. Recorded that for you guys a night ago or so. It's a 45 roughly minute video that goes into all how I'm investing in 2024, what I'm looking at, the stock opportunities, real estate, cash, all those sorts of things. So you should get some really good value out of that one. That'll be pinned comment for free access to that. Much love and have a great day.